Good afternoon. Good afternoon, traders. Welcome to ActivTrades Monday Market Matters webinar for the 30th of March 2026. It's Paul here, and today for our educational element, we're going to talk about how to best use moving averages. Great to have you here. Great to talk about this interesting topic. As always, it would be really beneficial if you can just confirm in the chat box that you can hear my voice and that you can see the slides. It's always good to know the technology is working well for everybody before we start our session. Don't want to leave anyone behind. Fabulous. Thank you. Thanks, David. Nice to see you. Okay. Thank you. Thank you, everybody. That's great. Super. Thanks, Kareem. Thank you. Thanks, everyone. Much appreciated. Much appreciated. Okay, so what should we talk about today? As always, with Monday Market Matters, we'll start off with a look at the news, what happened over the weekend and last week, and also what can we look forward to in this coming week. And then we'll switch to the educational element, where we will look at the what are moving averages, what do we need to be aware of when we use them, and most importantly, actually, how can they benefit traders? And then what we'll do, as always, is we'll switch across to the live markets, okay, to the ActivTrades platform to have a look at what's been going on in the markets. It would be interesting to know, for those of you joining us for the live session, and you're all very welcome here, it would be interesting to know what, if any, experience you have of using moving averages. Are they something that you know about and that you use in your own trading decisions and trading plan? Or are you at the start of your journey and not really sure what they are or how they can help you? If it is the latter, if you're at the start of your journey, that's absolutely fine, okay? That's absolutely fine. These sessions are here to help educate everybody. I do appreciate that we have a broad range of experience of people who join our sessions, from those who are at the very start of their trading journey to those of you who have been trading for some while. There is always something for me to share with you. There's always something for you to take away to move you forward in your own trading journey, regardless of whether you've been trading for 2 weeks or 2 decades. But it's great to have you all here. And as I said, if you can put in the chat box what, if any, has been your own experience with moving averages, what do you understand about them, what do you like about them, maybe what you don't like about them. That's absolutely fine. Absolutely fine. I encourage all sorts of conversation and debate here. That's what makes for good sessions. And as always, you're very welcome to ask your questions. Kareem says, I use it as a trend indicator on long time frames. Okay, fabulous. And you also use them as support resistance. That's good to know. Excellent, Kareem. Excellent. Good work. Good work. We're going to look a little bit more at that a little bit later on in today's session. But as I said, you're very welcome. Just put your questions in, or put what your own experiences have been of using moving averages, and I will happily debate and discuss and help you as I can. Just a reminder that we return in 2 weeks. Okay, next week is a bank holiday here in England, but we return in 2 weeks, 13th of April, and that session, the educational element, will be all about how to trade price action combinations. Okay, it's an interesting topic, builds on a lot of the other elements we've discussed in our session so far this year. I hope you'll join us for that. If you haven't already registered, you can do on the ActivTrades website, or even that QR code will take you to the registration page as well. Hope to see you there. As I said, remember, that is in 2 weeks. For those of you who don't know me, my name's Paul, traded for many years, traded for funds, traded for clients. Primarily, I look to focus on trading FX indices and commodities in my own trading. I tend to be a trend trader for longer term swing and position trades, and I tend to be a mean reversion and reversal trader for shorter term intraday trading. I will be sharing all those experiences with you today, especially when we talk about moving averages themselves. Okay, as always, remember, Money Market Matters is ActivTrade's regular webinar series where we aim to help traders start the week in the right frame as we prepare for the opening of the US market shortly. So each Monday, 2 o'clock London time, we take a look at the major news to be aware of for the week ahead. What is the sort of the news? What's the themes? What's the narratives that we can take on board? The main thrust of our session will be on an education piece to help you build your trading knowledge. We'll have a little chat also about the ActivTrades platforms and tools that you have available to you, combining that with a look at the live markets as we go into the US session. So there is always plenty for us to discuss. We're never short of things for to talk about or for items for me to share with you. And as I said, if you have any questions or any comments, please, by all means, feel free to put them into the chat box. If they're relevant to today's session, I will do my very best to try and help you as I can. Okay, so let's talk about the news. Now, you hear me say this every week that, if you are new to trading, I wouldn't expect you to be able to analyze the economic data, but it is very important for you to know when that major economic data is being released, because the major economic data is likely to induce volatility into markets, and that volatility can be a double-edged sword. When you're on the right side of it, it can be very beneficial, and when you're on the wrong side of it, it can make for a challenging trading session. So it is in your best interest to understand and know when the economic data is being released. You can find that and you can understand that on an economic calendar. There is one on the ActivTrades website you can utilize, and there are other ones elsewhere, okay, on the internet. So there's no excuse not to know when the big major economic data is being released. We have, a fair few bits of this week, okay, or important pieces, but I also do appreciate that let's say the overarching theme and concern and focus from markets is generally the ongoing tension and war that we see in the Middle East. And I do appreciate that whilst this is the English speaking webinars, I do appreciate that we have a truly global audience who join us for our sessions. So, on behalf of myself and everybody here at ActivTrades, wherever you are, I hope you're safe. Okay, I hope you're okay, and we hope that you're able to work through these rather challenging times. Okay, but of course, naturally, that kind of continued tension in the conflict between the US and Iran does overwhelmingly, focus the mind and focus traders and analysts and investors' minds about their impact upon markets. And certainly we have seen that over the last, as we enter the fifth week, and we've seen the impact that has had primarily on energy prices, and we have seen those surging, but also on markets themselves in terms of impact upon index markets, which have kind of come off their recent highs. We have also seen the impact on currencies, where we've seen the sort of dollar establish itself as the safe haven. We've seen its impact on government debt in terms of the yields rising on government debt and treasuries, etc., and also the impact upon commodities, not just energy, but generally commodities in total. So this basically has a huge impact upon markets, and I appreciate that has the overwhelming focus of people working upon that. Okay, and what we look at. We also have the formal economic data being released. This afternoon, we have Mr. Powell speaking, the chairman for the moment of the Federal Reserve. He's speaking at 3:30. That is 3:30 UK time. Please just, assimilate it to wherever you are joining us for the world. What we do see is that it's rare that we have major impact news on a Monday, but of course, as I said, we live in interesting times. So we have Mr. Powell speaking this afternoon. We then have Canadian GDP tomorrow afternoon, and also the American JOLTS job openings. And naturally, people will be keen to see the impact upon the sort of job numbers, because here we are at the end of the month of March. It is also the end of Q1 of 2026, which seems to have lasted, feels like it's lasted 3 years rather than 3 months. And also we're into the first week of the new quarter, the new month. So we also have the American jobs numbers, hence why tomorrow afternoon we have the US JOLTS job openings. On Wednesday, we have the ADP non-farm employment numbers. ADP is it's like a payment processing company, and so they basically get to see an awful lot of the, let's say, private employment numbers, and so that can be useful as an insight towards A, the overall economy, and B, the sort of non-farm numbers that we might see at the end of the week on Friday. It can be a little bit more volatile because it's the private data rather than public, but naturally people will be keen to see it. We also have US retail sales, okay, because of course people are going to be keen to see how well the American consumer is bearing up. And we also have ISM manufacturing PMI numbers. So, Wednesday, April 1st is going to be quite a busy session, okay, in terms of the amount of data and the spread of data in terms of the kind of the impact we will see. We have unemployment claims on Thursday as normal, and then of course on Friday we have the average hourly earnings, the non-farm numbers, and also the unemployment rate. I appreciate that will be kind of an interesting one, because for parts of the Western world, that will be seen as Good Friday. So what we also see is that at this time of the year, we also see lots of fund managers, major traders, investors. They are away on a break over the kind of this particular season and holiday. So it will be interesting to see whether anybody is taking holiday, or whether, because of the events going on in the Persian Gulf, whether everybody's sort of glued to their desk and glued to their screen. Okay, I suspect it's probably the latter. So there is big data coming out this week, but I also, as I said, it's important with the events going on in the Persian Gulf that you make sure that you are on top of your risk management, make sure you are on top of the news flow, make sure you are on top of the order flow. Okay, it is even more important than normal because of the volatility we have seen over the last few weeks, and I'll be able to show you that more when we switch across to the live markets at the end of our session. Okay, so we've had a chat about the news, so let's have a dig into our educational piece, and in particular, let's talk about using moving averages. As I said, it would be interesting to know, and you can put it in the chat box, what is your own experience of using them? Have they helped you? Have they hindered you? Are there particular styles that you particularly like to use if you do use them? Or maybe, as I said, maybe you're at the start of your trading journey, and you're learning all about them, and that's absolutely fine. That's what these sessions are here. But for many new traders, moving averages are a simple and popular indicator. Why are they popular? Well, as we go deeper into our session today, I'll talk a little bit about why people find them popular, especially at the start of their trading career. However, I will also talk about how many new traders can very often use them inefficiently in their own trading, right? Perhaps they may feel that they understand them, but actually they're not using them to the best of their ability. So in this particular session on the education side, we'll take a little bit of a deep dive into moving averages and discuss how traders can use them more efficiently in their own trading. It's something that I utilize in my own trading, so I'll be sharing some of my own experiences and my own ideas. And as I said, if you're using them yourselves as well, by all means, please feel free to put your own thoughts in the chat box, and I'll be interested to hear how everybody else's experience. So Kareem says, personally, they look confusing between timeframes and charts. I usually use them on monthly, weekly, and daily. So that's great insight, Kareem. Okay, thank you for that. I appreciate your honesty there. I appreciate you sharing your ideas and thoughts. And yes, like all indicators, they can be confusing if used inefficiently or sometimes relied upon too much, or they are used to either give sort of weight to confirmation bias, or sometimes they basically as a little bit of a means to abdicate personal responsibility on trading, which might sound a bit strange, but I'll talk about that a little bit more later when we go into the session. But I appreciate your comments, and it's interesting to use some of the monthly, the weekly, and the daily. Pretty much like all indicators, whilst you can use them across all time frames and all instruments, invariably the higher the time frame, I generally find the more validity they will often have. That's not to say I don't use moving averages on shorter time frames. I do, but I can understand why you prefer to use them on the longer time frames, and there's absolutely nothing wrong with that at all, Kareem. So as I said, many traders will start their trading journey. They begin with using moving average indicators, okay? But why is that? What is it that makes them popular? Well, for starters, they can be popular because they are a visual trading tool. And it has to be said, still, although it is changing, most traders are male, and most males are driven by visual cues. You can take your own ideas and thoughts and opinions upon that. Ultimately, it is just a visual trading tool, okay, that lots of people are drawn towards at the start of traders' journey, because it allows traders to view smoothed out data. And I find this very often with the completely new traders, is that because perhaps they don't have the knowledge, the experience, the confidence to read price action, whether it be candles, whether it be bars, or another variation. Moving averages allows them to smooth out the data and allows them to sort of get an indication of what the market might be doing, and then from that use that as a trading plan. And interestingly, the longer and the deeper you go into your trading journey, as I said, I still use moving averages, but they are a secondary support item for me rather than a primary indicator for people at the start of their journey, because I've traded for many years. I can read price action, and I have the ability to sort of understand and see what the price is telling me. Price is always king, but moving average can be helpful, and I'm going to share with you a few ideas on how it can be helpful. So remember, a moving average, if you're at the very start of your trading journey, a moving average is, as the name implies, okay, it's a moving line on your chart that basically adds up the last closing price of whatever period that moving average might be. In this case, it's a 10, or it could be 20, 50, 200, 600, etc. It literally is just printing a moving average of the closing prices of the last denominated period that you're doing it. So it becomes quite a visual tool, especially, as I said, for the start of many traders, when they haven't yet got the experience or the confidence or the knowledge to read price and be able to interpret that. What they are also very useful for, and is that they're also very useful for helping gauge the direction of the trend, the momentum within that trend, and the actual strength of that trend. And that's what I'm going to talk a little bit more about as we go deeper. And I want you to be able to take on board, as I said, other ways that you can use moving averages to help you in your trading decisions. As I said, very often, sometimes people get a little bit excitable about moving averages, etc. But actually, what I'm here to show you is to show you lots of different ways that you can actually utilize them. So once again, Kareem says, I learned how to use them as a confluence zone in parallels with other confluences like support and resistance, fib ratio, retracements, etc. That's really good, Kareem. Okay, you hear me talk about this every week. In that, I'm a big fan of using a confluence of events where you have two, three, four things come together at one time and place that will give you an indication of how your trade should play out, or rather, what is the highest probability of price moving in a certain direction from that particular moment, or that confluence. So I can back you and assure you that that is a very good way to use moving averages. Okay, and we'll talk a little bit more about that as we go deeper into our session. But yeah, thank you for your input, Kareem. So, of course, one of the questions we also want to talk about is, well, actually, what type of moving average should I use? Not all moving averages are the same, and we now have a veritable smorgasbord of different types of moving averages that you can use, and there are many options you will find across all sorts of trading platforms. Generally, I tend to find that most people are using one of either two versions of moving averages, either the simple moving average, the SMA, or the exponential moving average. What's the difference between those two? Well, in simple terms, it is speed. Okay, it is speed, but we'll look at that now a little bit more. Exponential moving averages give more weight to the most recent price action. Okay, and so when price changes direction, the EMA recognizes this sooner. However, the SMA, the simple moving average, which moves slower, tends to keep you in trades longer when you are trying to follow a trend. All right. So in this simple chart here, I've got a 20 EMA on. Hopefully you can see that, which is the dotted blue line. That actually turns faster than the 20 simple moving average at the reversal point here. So let me just bring up the old drawing tool here, ladies and gentlemen. We've got a dotted blue 20 period and a straight blue simple moving average. And actually, as we can see, as price reverses, it turns faster. Okay. And for those of you who are excited, well, that might in itself be a trade idea there. It is my own view is that I use mostly SMA simple moving averages, but I do also have an EMA on my charts as well. Generally, what I will find personally is, you can see that there is a little bit of difference, but generally, I don't feel that it is bigger difference. Okay, for me. Now, I appreciate I'm an experienced trader, and so as I said, I'm able to read price beforehand. But I do realize and recognize that if you're at the start of your journey, as I said, people maybe attach more weight to moving averages because they are waiting to try and understand and read to understand price action itself. The first question is, what type of moving average should I use? Then the second question is like, well, what's the best period moving average to use? And yeah, it's an age-old question, okay, and one that has been debated down the ages. And if you wish, and I know people who spend their lives testing combinations of moving averages. Okay, for many years I've spoken at conferences, I've run trader meetups, and if you put traders together who use moving averages, you will find a constant debate about which are the best, and you'll hear people talking about how the 65 period EMA is not as good as the 62 weighted period moving average, which is not as good as the 55 EMA, which is not as good as the 50 MA, which is not as interesting or as useful as the 89 SMA, etc. It is literally a rabbit hole of its own that you could tumble down and happily get caught up in. And as I said, I do know quite a few traders who quite literally spend their life testing combinations of moving averages across every chart that they trade. And if you have the skill and the technology and the patience to do that, then by all means, that's a path you can go down. It's a path lots of people go down. Personally, my suggestion after years of experience is just I just stick to the commonly used moving averages. Okay, why is that? Because you will find that they generally tend to become a self-fulfilling prophecy. You have so many people using them that by their very nature, as I said, they become a self-fulfilling prophecy, and it is perfectly good enough. I think you could, as I said, you could spend an awful lot of time and energy trying to sort of curve fit and fine tune every moving average to every chart. And that might be your personal choice, or you might have the skills to do that, and certainly the technology is available these days. But generally, I tend to find, the commonly used ones are perfectly acceptable, perfectly good for what I utilize them for in terms of trading, and for what I'm going to share with you here as well. So why don't we take a little bit of a look at some of those different types of moving averages. So you'll find, as I said, there are lots and lots of different ones, but there generally tends to be, very simple standard major ones, which you notice, as I said, become that self-fulfilling prophecy. So very often you'll hear people talking about the 10 period moving average. I personally use an 8 EMA for my very short term, but I have it for specific tactics. But I certainly do have, you can have a 20 or a 21 period moving average. Some people prefer 20, some people prefer 21. Once again, I don't think there is enough of a difference between them. Okay, if you plot a 20 period and a 21 period moving average, I don't think you'll find, enough of a difference to do it, but it is a useful filter for the short-term trend. The 50 period moving average is one I use a great deal, okay, and that's used for the medium-term trend or as a definition of fair value. All right, that's one of the reasons and ways that I utilize it. It's a definition of fair value in the market. And so when price has pulled a good deal away from the 50 period moving average, that in itself can give you some insight into the into whether that that particular instrument, whether it's overextended, whether it is deemed to be below value, or whether it's deemed to be sort of, maybe a little bit excessive. But you'll find lots of traders use the 50 period moving average as a definition of fair value. And then you have the 100 and 200 period moving average used for identifying the longer term trend. I have on my 4-hour charts, I have a 300 period moving average just on my 4-hour charts. Why? Because that's pretty much the same as the 50 period on the daily chart. And so if I'm doing a lot of work on the 4-hour charts and swing trading, I can see that when that's in front of me, and it can be either a place that becomes a natural target, or it becomes a place that, I might see or expect to see price reverse off it. So as I said, you could spend your life finding lots of, and I'm sure even the people here today have probably seen and heard of lots of other different types of moving averages and different periods, but really generally 10, 20, 50, 100, 200, they're pretty much the standard ones. And as I said, they become that self-fulfilling prophecy. They are good enough for what we need them for what we're going to talk about with our trading. So yeah, you'll see on most of my charts, I have a blue 20 period moving average, a red 50 period moving average, and a green 200 period moving average. So, in particular, the green 200 period moving average, my understanding is that that the reason that became a self-fulfilling prophecy, and maybe this is urban myth, maybe this is urban legend, but my understanding told from me from working on trading floors is that when traders on trading floors, they were given their Bloomberg terminal or their Reuters terminal, when they sort of had charts come up, the chart always had a default green 200 period moving average on it, and so it just became default just because that is the way the traders saw that on their Bloomberg terminals, that it just became self-fulfilling prophecy. And even here now, 20, 30, 40 years later, it still remains that it's still a potent signal. You'll hear lots of big investors, big traders, even people like Charlie Munger, the late great Charlie Munger talking about, the impact and the effect of the 200 period moving average, whether it be on a weekly or a monthly or a daily chart. Okay, mostly a kind of weekly or daily chart. So, as I said, they become self-fulfilling prophecies. And just so you recognize my charts, I normally have a blue 20, a red 50, and a green 200. Occasionally, I might have one or two others on just if I'm testing an idea or concept or a particular idea. So, for example, as I said, I quite often have the 300 period moving average on a 4-hour chart because that's the kind of equivalent of a 50-day period moving average on the 4-hour chart. So, we can do it like that, but it's generally, as I said, for what we're looking for, the standard moving averages are perfectly fine to work with. So if we've talked about, what moving averages should be used and about what time period, should be used, well then naturally it leads us on to the third and some might say the most important question, namely, well, how can I use them in my trading? How do I actually use them to help me make better trading decisions and be a better trader and investor? And so there are many ways to use moving averages for identifying trade opportunities. So why don't we have a little look at a few of them? Maybe some of them you're already aware of. Maybe some of them it's new to you, and that's great. Maybe some of the ideas will resonate with you. But maybe some of the ideas won't make sense to you. And once again, that's absolutely fine. Okay, that's absolutely fine. There's no judgment. It is about, as always, what is it that resonates with you and that works best for you? And sometimes that means, well, very often that means you might have to take an idea here that I share with you or in other sessions, and maybe you have to tweak it, or refine it to your own style, your own particular type of trading. And that is absolutely fine as well. Okay, what I try and do is I try and provide the kind of the baseline of education as part of your journey, as part of you moving forward and developing and evolving as a trader. So, first way that you will find traders using moving averages is very often at moving average crossovers. Okay, this is a very popular trading strategy with new traders, and basically you place a trade when a faster moving average crosses a slower one in the direction of the cross. Okay, I always try to share the pros and cons of everything I share with you because there is no perfection. Nothing works perfectly all the time. And the thing with just a simple moving average crossover is that it works well in trending markets, but it works poorly in consolidating markets. Moving averages work best when there is a good trend. So it works well in trending markets, but it could be said that everything works well in a trending market. So very often, people come to trading, they start or they're sold or they're told that, yep, all you need to do is to trade a moving average crossover. And when in this case, the blue 20 crosses the slower 50, that's when you buy. And then invariably once the blue 20 crosses back beneath the slower 50, that is when you close your position. And so, you've got long here and you've exited here. And that looks fantastic, doesn't it? Everybody's happy, everybody's excited, everybody starts to project forward in terms of how that could impact their trading and their equity curve. And as I said, moving averages look fabulous in a trending market like that. Okay, and that's what attracts people at the beginning because it appears to be simple, it appears to be visual, and it appears that if you can't read price, well, at least you can just follow the moving average. And so I can understand why people are attracted to that at the beginning of their journey. But as I said, the problem is, those moving averages, they work very, very well in trending markets. But the challenge you have is when you are into a consolidating market, whereby you get whipsawed. Okay, you get constantly whipsawed, and you're buying when it crosses up, selling when it crosses below. And as I said, once you're into into a kind of a tightening, consolidating range, then moving averages lose their usefulness. All right, they lose their usefulness. They still can be of use, and I'll show you a little bit. We can talk about it when we look at the live markets, but generally, moving average crossovers work well in trending markets and they work poorly in whipsaw crossover markets. Okay, so you have to be aware of that. There is, as I said, there is never a perfect trading strategy. Every trading strategy has pros and cons, and it is about working out, which ones work best within the market environment you find yourself, and also your particular trading style as well. But as I said, lots of people start out there, and as I said, they can work well in trending markets. What you'll very often find, especially I would suggest in financial media, is that they like to sort of use very simple, popular versions of moving average crossovers. So if you're new to trading, investing, you'll quite often, if you watch financial media, you'll hear them talking about a death cross, which is where the 50 period moving average crosses below the 200 period moving average, or you'll hear a golden cross where the 50 period moving average crosses the 200 period moving average to the upside. And lots, as I said, lots of the financial media like to talk about it, but if you look at here, in this particular case where we had this death cross, if you'd have sold there, well, you wouldn't have had much joy. And equally, if you'd bought here, well, yes, there is a little bit of move, but actually, you are very, very late to the move. So lots, as I said, lots of people talk about death cross and golden crosses, but they are not they're not necessarily the smartest way to use a moving average crossover. But you will very often hear them used in the media because it's easier for media people to understand and share with you. That's why, but it doesn't mean it actually is of any real help or benefit to you as a trader. And that's generally the most important thing for us, isn't it? Secondly, a way we can use moving averages, is to use a moving average as a place to stick your trailing stop loss placement. And this is a good example of where moving averages can help you have a very simple way to trail your stop in order to stay with winning trending trades for longer. And depending upon whether you're a short-term or a long-term trader, you might place your stop loss behind either the 20 period or the 50 period moving average. So sometimes, some traders, they struggle with staying with their trade. They're overwhelmed by their greed and they like to basically snatch profits and they find it hard. And actually, well, what can be happen or helpful is, let's say, for example, that when price breaks out through this level of resistance, people might have traded the breakout, but with their stop beneath the sort of the recent lows here, and actually then sort of looking to trail their stop. And so actually the stop doesn't occur until price closes the other side of the 20. In this case, that would have been here. Or maybe, depending upon your style and your particular trading goals, maybe it's the 50 period moving average, which you can see it closes the other side here. So you're in that trade much longer, and that could work out better for you. Once again, there's no perfection, but it can be a simple way, a simple visual way for once your initial stop is placed, you can say, well, actually, my plan is that I stay in this trade until price closes the other side of the moving average. Maybe it's a 20 period, maybe it's a 50, maybe it's one of your own. Some people like to trail it behind the 200 period moving average. Personally, I think the 200 period moving average is a little bit too slow to use as a trailing stop. But there you go. That's my view. There will be other people who would differ and would like that, and that's part of trading. But if you are struggling with having a stop and trailing it and trying to stay in the trade, well, then just having a very simple mechanical stop loss placement, which with modern technology could even be coded up for you as a robot, an algo, an EA. That might be a beneficial way to use moving averages to help you stay with your trades. Be interesting to know if any of you here today with us. Have any of you do any of you use that in your own particular trading, or have any of you considered that? Maybe it's completely a new idea. That's absolutely fine. One of the next best ways to use moving averages, and it's one that I particularly like myself, is actually to use moving averages as areas of dynamic support and resistance on your charts. Okay, so what do I mean by that? What does that actually entail? Well, you will hear me talk a lot about support and resistance. You'll hear me talk about it in terms of horizontal levels of support and resistance, or perhaps big round numbers. Okay, so gold, we're around 5,000. Oil, we're around $100. Okay, and so they become horizontal levels of support and resistance. But a moving average, because of its nature, is dynamic, because it's constantly moving, it's constantly being updated, and one of the reasons for using popular moving average periods, okay, the standard ones we talked about, like 10, 20, 50, 100, 200, is because of their self-fulfilling nature. There are lots of traders, lots of algos, placing trades around popular moving averages, okay? And so this provides an area to join a trend trade and one of its pullbacks. So in this case, the price is clearly in a downtrend, it's beneath its averages, and actually when it pulls back, in this case to the 20, well, we see the price action showing that it has becomes dynamic resistance before price moves away. We can see again, price pulls back to that 20 and it keeps moving away and down. And so that is one particular way I like to use, especially if like me, I prefer to trade pullbacks rather than breakouts. So price might be in a trend, but when it pulls back to a dynamic area of support resistance, maybe that's the 20, maybe it's the 50, maybe it's even the 200, and then you get a confluence of events. We're in a trend, it pulls back, it's back to a moving average, and gives us a price candlestick in the direction we want to be trending. Well, a little bit like Kareem earlier, that it is a confluence of events that allows you to give you an idea to form a very simple trade plan that allows you to trade in the direction of, in this case, the sort of the longer term trend. So you'll find that that's certainly something that I like to use. Okay, it's certainly something I'm very aware of. Okay, just I have the cognitive recognition ability to practice watching that. But then even these days, on some of the trading platforms you have available to you, you're even able to set alerts to alert you when price touches certain moving averages. So there is always ways and means that you can work with the technology and work with that to fit it to your own particular trading style. And one of the other ones is using the 20 period moving average as an early indication of a trend change. So generally, we associate moving averages with trends and trend following and trend trading. And, as I said, in good trends, moving averages work very, very well. But what we can also do is to use the 20 period moving average as an early indication of a possible trend change, okay, of a possible trend change. And in this, it can be a very useful tool to help you confirm that change, okay? So what I always suggest is watch how the price reacts to the 20 period moving average after recent highs and lows, and also recent reversal patterns, okay? Because that can be confirming to you the basis of a reversal and the basis of an opportunity to trend. So we've got a chart here. I don't know what time frame it is. I can't even remember what instrument it is. And that's the important thing. It shouldn't matter, because once you identify this, you should be able to see it across all time frames and all instruments. And in this case, remember, I have blue 20 period moving averages. Well, it's been supportive here. Okay, this is where it's been acting as dynamic support. We then get up to a horizontal resistance level here. And what do we place? Well, we print a double top there, don't we? And then what happens is we know the 20 has been support in the past, but actually it starts to change, doesn't it? It starts to close behind it, and price drops, and then price rallies up. But look what's happened here. Okay, the 20-period moving average, which has been in an uptrend, has started to turn, hasn't it? It started to roll over, and suddenly, remember what we just talked about, dynamic levels of support and resistance? The 20, which was acting as support in the uptrend, is now basically flipping, and it's become resistance. And in this particular case, this sort of, we've got this rejection candle here, pin bar candle, before actually what happens is woomph. You can see how price drops there quite significantly. So, as I said, it can be a useful tool to help you confirm the change of a trend. And what you find is that the reason is that the 20-period moving average, there are lots of very, very simple buy and sell programs, on floors and institutions that literally just trade up and down and off the 20-period moving average. So let's just clear off these drawings, shall we? So, when price comes down to the 20, it will just automatically buy the 20. But equally, when price comes up to it from beneath, price will, the algos will automatically short it as well. It's a very, very desperately simple buy and sell program. Okay, nothing terribly esoteric about it at all. But once you practice and once you train your eye to see it, well, then you won't miss it. And as I said, especially after you've had a good trend, or in this particular case as well, you've had a good reversal pattern. Perhaps maybe you're not a reversal trader, or perhaps you want to see more confluence. Well, when you see that confluence occurring there, well, then that can be the opportunity to position yourself into a new trend. So, as I said, lots of people use moving averages for trend following, and as we've seen, they can be very useful, but they can, on occasion, also give you an indication of when the trend might be changing. And the dollar index, if we get time, we'll switch across. The dollar index has been a very good example of that recently. Okay, there you go, legend. Before we switch across to the live markets, just a reminder that Monday Market Matters is here to support you in 2026. You're always taking a look at the news, at education, markets. Okay, yeah, I said it in the first week of the year. It's going to be an interesting year in the markets, and I think it's fair to say that it has been, hasn't it, ladies and gentlemen? So if you remember what we've talked about here, moving averages are a popular trading tool for new traders because they're a visual indicator and help smooth out data. It's important to understand whether you're using exponential moving averages or simple moving averages. And I also think it's generally best to use common period moving averages because they become a self-fulfilling prophecy. With regards to trading them, generally, I suggest for new traders, you should avoid moving average crossovers unless you have good trends. But moving averages are useful for helping confirm trends and confirming the momentum. They can also be used to help you confirm reversals in the markets, like the power of 20-period moving average. They can also be used as a guide on where to place your trailing stop losses, and also as a place where to enter into trending markets when we see price bounce off those dynamic levels of support and resistance. So there are lots of good ways that you can utilize moving averages to help you with your trading decisions. And with that in mind, why don't we go and have a little look on them on live markets? As I said, just another reminder, we return in 2 weeks. Money Market Matters will be back on the 13th of April, where we will be talking about how to trade price action combinations. I hope you'll join us for that. You can register on the website or use the QR code there to take you to the registration page. And remember that ActivTrades is also on YouTube, and so I would hope that you would subscribe and follow us on there. You will find that an awful lot of my previous webinars are on there, and you'll see them that you can actually be able to watch them. I appreciate that sometimes it helps to be able to watch, an educational piece a few times just for the concepts and the ideas to click into place. And so hopefully, as I said, you'll be able to follow them on there, okay, and utilize them. So Kareem says, I'm interested about designing algos on the MT4 and MT5 platform, like you said, an example of the early indication of the 20 MA cross or as an automatic stop. Yeah, that's absolutely right, Kareem. And there are lots of already created EAs, algos, robots that you can utilize. But equally, these days, it's not terribly difficult to have somebody code up, or maybe you have the coding skills yourself. I certainly don't. I know I'm a trader, not a coder, but you can utilize all of those things to help you, especially with something like a moving average. Yep, you can build all sorts of EAs and algos to help you. Okay, so as always, let's switch across to the live markets. Let's have a look at the ActivTrades platform. As always, if you've got any questions or comments, you can drop us a line here. You can call the English desk there, 0207 6500 567, or you can email englishdesk@activetrades.com, and you're very welcome to do that. Maybe you've got some questions or comments or thoughts. Maybe there is topics that you would like me to sort of touch upon in future sessions. Okay, by all means, you can put them in there, and we'll talk about that. Okay. Kareem says, "Thank you for today's webinar." Yep, you're very welcome, Kareem. But if you'll just bear with us a moment, I'm just going to switch across to the platform. Okay, and we'll have a look at what's going on there with the markets at the moment. Okay, so here we go. I'm hoping you can still hear me. I'm hoping you can see the charts. Okay, this is a dollar profile. So I've got Aussie dollar on the daily, Kiwi dollar on the daily, Euro dollar on the daily, pound dollar, dollar Swiss, dollar CAD, dollar yen, and also the dollar index. And as I say, when I'm looking at the FX world, I always start with the dollar index. It's the big daddy. I want to know what the score is and what's going on there. So let's have a little look at that, because there's some interesting elements that we've talked about in the session today that hopefully you might be able to see them playing out there. So weekly chart, okay, weekly chart, the dollar index. I know some of you join us regularly, and you can see how prices worked its way down there. And as you said, you can see the 20, the 50, and the 200, okay, across all time frames. And certainly, not unsurprisingly, when price is beneath those moving averages, that's just giving us confirmation that price is price is most definitely in that downtrend. But of course, we have had rather eventful, rather volatile markets, haven't we, over the last few weeks? Okay, in 2026. So why don't we have a little look down there and go on to that daily charts here? So what I'm interested to see here, I'm just going to zoom in here. This is the daily chart here, and once again, daily chart. I've got the 20, 50, 200, and what we can see is we flushed down here. This was actually the levels of previous year, 2025. This was, I think, this is when we had the FOMC meeting, and you can see price popped up there and bounced off it. But where did it stop? Okay, it stopped at the 20-period moving average. See how it came up, and then it dropped away. And then it came up here, and then it printed a sort of, a pin bar. And I was interested to see, well, actually, we have a trend line there. Could it break that and continue lower? But actually, it went higher. And what actually happened is here, we can see, this is kind of interesting running into the end of February. Price was just pivoting around that 50-period moving average. Remember what I was saying earlier, that sometimes, well, I do, and lots of other traders might use it as a means of fair value. And so when prices far extended from it, it's no surprise to see that we get a mean reversion back in that direction. Okay, but what I was kind of also curious is, as I said here, the 20-period moving average has acted as dynamic resistance. Tried to here, but we've flipped here. We've gone up to the 50, and then we've come back down. And where have we come back? Well, the 20-period moving average has turned, hasn't it? It's turned upwards, and here it has flipped from being resistance. Here, it's now flipped to being support, and we can see that price, cut its way through, came back down, and then went up to the big round number 100. And I was intrigued to see how we were playing here, because I thought, well, do you know what? Actually, let's clear this down. Are we going to have, let me just clear these drawings down, make it a little bit clearer. Are we going to have a double top here at 100? And that's what it started to look like, okay, with this nice engulfing candle and then this rejection candle. But once again, as I was saying, those of you who join me regularly, I was talking about how, well, you know, the 20s resistance here, support here. Look what happened here. The 20 has, you know, 20 priced is above the 20, above the 200, above the 50. And if we look here, the 20 has acted as dynamic support again. As now, you know, I was talking about here, if price had broken that 20 and closed the other side, then I would have been expecting us like a tactical short down towards that 200 period daily, but it hasn't. It held, the 20 held, and actually we've gone back up to the 200 there, haven't we? So, as I said, you know, the 20 and the 50 and the 200, they become self-fulfilling prophecies, right? They become self-fulfilling prophecies, and that can be beneficial. And as I said, you can utilize it to help you frame the markets that you're looking at, frame the charts, and see how does price react to them. Does price, you know, like here, it just pivots around the 50 there, doesn't it? Just pivots around the 50, but then also, you know, does it have the 20 acting as dynamic support that helps just give you a little bit of confirmation of the of what's, you know, of where the trend and the momentum and the speed is going and stuff. So that's why I kind of look at that, and it's relevant to what we see going on at the moment in the charts themselves. If we go into, let's see, yeah, you know, and here we go once again. The 4-hour chart here is, this is the 4-hour chart, and you know, I was intrigued here. Once I've got the 50 period moving average here, let's just maybe try and make this a little bit so we can work with it. Yeah, you know, once price is here, price is in its trend on the 4-hour chart, above its 20, it's above its 50. Here is this little dotted line is the 300, which is the daily, and then I've got the daily 50 and then the 4-hour 200. When I'm in a trend, price comes back to that 50. Remember I said it's like once it's away from it, it becomes fair value and it reverts back to it, and then it puts in that really nice bullish engulfing candle, you know, and you can see that basically it worked. It bounced off the 50 here until it didn't. It sliced through it, came back up to it, turned it, and worked its way down. Okay, so that's why, as I said, I like to see how does price react to those major moving averages on the longer time frames. I know some people here joining us will be on trading shorter time frames, but you know, I primarily use mostly the longer term time frames myself. So, you know, I'm always looking, as I said, 4 hours, dailies, weeklies in particular, but also, you know, intraday. But it can be enormously beneficial, okay, just to see how does price react to that, how does price move, and as I said, to see the number of buy and sell programs that sort of respect that and work with that to give you an indication of you know, what the underlying market is likely to be doing. You know, if I look at here on the Kiwi dollar on the daily, and what I was sort of saying is price here had been in a very strong trend. Okay, it hadn't been particularly pretty, but it pivoted around the kind of 50, rolled its way up, and then it put itself into this double top here, and then it broke here. The 20 acted as support, and then it flipped, and then it came back up, and the 20 had turned, and once again it couldn't get above, it couldn't close back up above the 20, could it? This was basically another a lower high before price went down to the 200, came back up to the 50, where the 50 and the 20 were, and has worked its way down from there back to that 200. And now I see this personally, based upon what we've been going on in the kind of war on, war off, we've just basically been pivoting around that area there, okay, and that's, you know, but now we've broken out of it, now we've continued out of it, okay. But here, as I said, reversal patterns, then watching how that 20 reverts after it, that can be a great way to basically confirm that a reversal has occurred, and you can utilize that to help you with your trading choices and trading decisions in terms of your overall analysis, and where and how you'd like to trade that market. Okay, ladies and gentlemen, all good things must come to an end. Time flies when you're having fun. Unfortunately, we've kind of come to the end of our session here. Okay, so I hope you have found that useful. I hope that's given you a little bit of help and a little bit of insight that you can utilize into your own trading. Okay, on different ways to use moving averages. As always, I wish you the very best of success in your own trading endeavors, ladies and gentlemen. I hope you have a fabulous trading week. As I said, there's lots going on, so make sure you're on top of your risk management, make sure you're on top of the news flow, make sure you're on top of the order flow. And as I said, we are not here next Monday. We return in 2 weeks to talk about price action combinations. I hope you will join us for that. And as I said, have a fabulous trading week, everybody. And I look forward to speaking to you soon. Take care and trade well. Cheers.